Welcome to Gold Silver Pros.
Everybody, this is Rob Kientz of 𝑔oldsilverpros.com. It is Thursday, January 4th, 2024. I'm going to have to use to saying 2024. Today, we're going to have a rather short video because not a lot of economic data out, not too much going on. So I wanted to take a look at something that I think is going to play a big role in the economy this year, and that is the repo market as well as the commercial deposit market. The repo market has to do with overnight lending and funding of businesses and liquidity in the debt-based system. And when those numbers fall too low in terms of the overall amount of liquidity, it generally means the economy is seizing up. And I'll kind of explain how that works today, as well as I'm going to explain what happened with that mysterious $1 trillion of cash that left the U.S. commercial banking system and where it went and why it went where it went, because I think you'll find that pretty interesting. People are hunting for return because they need money because we've had inflation. And we'll talk briefly on inflation. Then I'm going to bring you some special deals for the week that I think you guys will be interested in. All right, we're going to go pop over to our charts. Here's a chart from the Office of Financial Research on the repo market transaction volumes by venue. And I'm not going to concentrate on the different colors, just the overall amount. You'll notice that the repo market turned over at the end of April, beginning of May. And there's a reason why this occurred. And by turning over, I meant that more people were participating in the repo market up until May of this year at about the time we had those three major bank failures. And then the amount of investment into the repo market has plummeted since then. Let's kind of explain why. Well, what is the repo market? So the repo market is the short-term, usually overnight, or could be very short-term lending market in which one entity or company or government office will put up they'll look to borrow money. So they'll put up security as collateral, and that security usually is a treasury security, short-term treasury security, mortgage-backed security, those types of securities. They'll put them up and borrow money against it with the understanding that they're going to pay more money back later when they get the collateral back. And the difference between what they borrowed and what they paid back in that overnight rate or few-day rate is the implied interest rate. It's basically what you get or your profit at the end of the day. And depending on how much money is in that system is how liquid the repo market is. Now, a lot of companies and entities use the repo market to borrow cash to finance overnight transactions instead of taking a big loan for 2 or 3 years. Sometimes it's easier to do this on a short-term basis. And those that have securities wanting to make a little bit of money and are willing to, put that good asset up, can get money for doing that. So it works on both ways. It allows people to borrow and allows people to lend. And the difference between what that was bought and sold at is the interest rate that's earned. So here we have the repo transaction volumes. Repo is where you put the security up. Reverse repo is the opposite. This is Treasury securities sold by the Federal Reserve. So you'll notice right at the beginning of May, end of April, this turned down. So the overall amount of reverse repo that the Fed had been engaged in had fallen at the same time. So the entire repo market from both sides fell at the same time in May. Why is that important? That was when the banks were having issues and were starting to fail. Right after that, the repo market started to freeze up, and the amount of cash to help fund businesses had started to fall at that point, and the amount of treasury securities put up started to fall at that point. Why? It's because we reached the 5% mark, or really close to the 5% mark in the repo rate. And again, that's the difference between what you're borrowing that money at and what you're paying it back at. That's your interest rate. The overnight repo rate right now is sitting at about 5.5%. That's intense for an overnight rate. But once it got about 5%, right around that April-May timeframe, and it spiked above 5%, this is when all of those markets started to turn down. Why are they turning down? Because while if you're borrowing money, 5.5% is a lot of money to pay, to borrow that money. If you're lending money, you love it. If you're lending money out and you've got cash and you're lending it out and you're taking this treasury security as collateral, you're doing great, because at 5.5%, that's great money. That's more than the federal funds rate. So you're beating the federal funds rate just by lending your money out. If you're borrowing money, it gets very problematic, because where are you going to earn that kind of return? Are you going to earn it in the stock market? Are you going to earn it, investing in bonds? You're not going to do that, because that rate's above what the bond rate is. So that's why this chart's important. Once it got around 5%, I believe that's when the repo market started to break, because it's too expensive for that market to operate. It needs to be lower interest rate for that short-term market to facilitate those borrowing needs. People can't afford to pay more than that. And so essentially what you're seeing is, as the Fed drove rates higher to 5%, 5.25 to 5 last year, that 5% mark is where the market started turning over, and people were like, well, that's too high a cost of borrowing. So instead of doing that, I'm going to go somewhere else for my money. Maybe I'll take on a long-term bond, whatever the case may be. So that changed the dynamics of the market. Why does a repo market matter at all? It matters because when this market starts to freeze up, and the estimate by the Fed and some other parties was about less than 1.2 trillion of liquidity available, the market freezes. There's not enough short-term cash available. There's not enough short-term securities to use to collateralize or to guarantee those short-term loans. And so the market starts to freeze, and then they go to the Fed and beg for more money. They beg for quantitative easing. So I believe, and this is why a lot of people believe, that quantitative easing may start again, because the repo market has started to freeze up, and the tighter conditions, the Fed raising rates and even buying back some other longer term, running off of the balance sheet, selling of their longer term debt issuances, froze the market. It was quantitative tightening. And I think that once the Fed got to 5%, that's what broke the repo market. And that's what's breaking the entire market, because that rate is too high for the economy to function. So everything's starting to slow down. People are putting up less Treasury securities, and people are borrowing less when it's over 5%. And you can see that occurred at the same time that these markets, the reverse repo with the Fed injecting, and then the regular repo, the other side of that trade, began to freeze up. And 5% is a magical marker there for borrowing. So what that likely means is, sometime in the next 3 to 4 months, if we look at the rate at which these are decelerating, sometime by May to June, we should start seeing a lot more consternation on the repo market. Probably will have fallen below the 1.2 trillion liquid. It's actually under it right now. If you look at least the reverse repos under 1.2 trillion. The rest of the repo market is still okay. You're still looking at the trillions. But once that falls below the 1.2 trillion, the Fed believes, and it's already in that danger territory from the Fed's perspective, that that's not enough liquidity. So right now we're not sitting with enough overnight cash liquidity in the system for the economy to run. And that's what happened in 2019 when we had the repo market issue. There was a lot of taxes due. Companies pulled their money out of the repo market to pay taxes, and the repo market started to have some major issues, and the economy started to skid a little bit, and the Fed had to intervene there, by addressing their interest rate policy and things like that. Back in 2008, in the Lehman crisis, the repo market froze up before the Lehman crisis, and it was that lack of funding which really caused the entire U.S. financial system to start to shudder and have issues. Well, we're starting to see that now. We're starting to see a lot more repo funds available, and the interest rates have gotten too high. And so this, at 5%, the whole economy starts to slow down. Now, this also, the federal funds rate being over 5% will also affect the ability of borrowers to pay that back over time. That's, many studies have been done on that. Once you get over 4%, with the amount of debt outstanding, whether it be sovereign debt or corporate debt or personal debt, once you get over, a 4% interest rate, everything slows down. So we're in the slowing down before the crash of the economy, and it's depicted in these charts. I wanted to also talk about U.S. commercial bank deposits. Where did a lot of that money go that people withdrew from U.S. commercial bank deposits? Well, a lot of it went to retail money market funds. So the commercial bank deposits are a different way of looking at money. That's very, very liquid money that the banks typically pay very little interest on. Retail money market funds, they're paying, in some places over 5%. So people withdrew from these lower interest bearing accounts and put them into higher interest bearing accounts. The problem with retail money market funds is the reserve requirements for money market funds is so low that it's very dangerous to put money in them, because it isn't guaranteed. If you know what I mean, it's not backed up. It's fractional reserve. just like the banking system. So just because people are hunting for more return in the money market, and you see this big spike in the money market rate you see here on the end of the chart, doesn't mean their money's safer. It's probably less safe in that market than it would have been in the commercial banks. But it throws a commercial bank balance sheet off, and it causes them to have issues with deposits, making some of them closer potentially to an insolvency event because they have less available cash. And cash is the best thing in the banking system because there is no downside liability in terms of value unless the dollar is crashing, going away, literally at that time. But as long as the dollar is a solvent currency, which it is, and it's a world reserve currency, which it is, cash is the best asset to have on your balance sheet as a bank or any company, because you can pay off debt, you can buy back stock, you can invest in property, plant, and equipment, you can reduce liabilities. Cash is the most liquid and the most accepted form of asset on the balance sheet. And the banks are losing some of that operable cash to do some of their investment. And these interest rates have caused the repo market, the overnight funding market, to dry up. So what's going to happen, what I showed you last week, is the banks now have gone to that bank term funding program, BTFP, where they're borrowing money there and they're pledging their crappy debt. So they're not able to pledge their crappy debt in the repo market. So they went to the BTFP, the bank term funding program, to pledge their crappy debt. And, the Fed's responsible for that. So the Fed now has a lot of this crappy debt as collateral on its books, lending out money, which it's likely not, to get back. So looking at it, from those three angles, the repo market, the cash deposit market, the bank term funding program, 2023 largely was a way to temporarily offset the risk of the banking system so that it didn't crash. So there were some lessons learned from 2008 and 2019 when we had the short-term repo crisis on how to handle that. And as the repo market has started to turn down, there's less cash available, less securities available. People have moved to like the bank term funding that was created, to be an additional lender for bad debt in the system. So most of what had happened between like the FDIC, the Fed, and the commercial, banking sector in 2023 was basically to paper over and cover up the issues in the system. And that's why the system has been allowed or has been able to limp along for as long as it has. And you can see what happens at 5% interest rates. The total economy starts to slow down. People go hunting for a return when interest rates are 5% and the money's in the bank account earning very little. So the banks in that case, because they were offering very little on their regular short-term deposit accounts, people went to money markets. So a lot of cases they can still invest those, but they have to pay a higher interest rate. So it worked against the banks. The banks now have more interest rate liability than they used to for those same funds, but they're able to borrow less in the overnight market to help fund themselves. So now they've gone to the BTFP, pledging their crappy debt essentially for government funds, but the government can only take on so much because they're talking about the central bank. And eventually the central bank's not going to be able to fund all the bad debt in the system. So I think we're very close to where that system rolls over. We don't have the liquidity we're going to need to offset a banking crisis. From right now to whenever, that repo market does not have enough liquidity to offset a bank run or a bank crisis in the U.S. system. The BTFP would have to get demonstrably bigger, by the Fed to be able to do that. And that means the Fed is taking on all the bad debt in the system. And I predict in 2024, the Fed is going to greatly expand those systems to take on a bad debt. And a lot of that bad debt risk is going to be transferred from the commercial banking sector to the Fed. And that may be ultimately what puts the final nail in the coffin of the Fed, is that they're going to have to print dollars, their only asset, to pay off all that bad debt that's going to crash at some point when the economy crashes, because they're going to have to print so much it'll lead to hyperinflation, because people at that point are going to realize you're directly monetizing all the bad debt. People are going to know about the bad debt. You're going to have bank failures. You're going to have corporate failures. You're going to have bankruptcies, bond covenants and things are going to be, exercised. You're going to see spikes in bond rates. You're going to see volatility in markets. You'll see a stock market crash at some point. Gold and silver will go up, maybe some of the private cryptos as well. And at that time, the Fed's going to come out and expand the BTFP, and they're going to institute probably other programs that are directly injecting cash into these markets with bad debt. And people are going to figure out you're just buying bad debt. Now the Fed's insolvent because the Fed is going to have all this bad debt, and the Fed's not going to be able to do the entire economy. So a lot of these banks are going to go under, because when you mark to market, or people figure out that you're not marking to market your assets, which are debt based, and they're worth less, they're basically going to pull out. They're going to sell stocks. That's going to create the stock crash. There's going to be a panic in the corporate sector. Bond rates will spike at that period of time. The Fed, the FDIC, all these government agencies will get involved, and you'll start to see that rollover. And the signs are already there. The grease in the wheels of the economic system is tightening up right now. And then all goes back to the Fed raising interest rates to about 5%. They thought they needed to do it to tighten things down, to give themselves some ability to work with a recession where they had the 5 full interest rate points to work with. But what that did was actually cause the recession. And we're starting to see that in the data flows in the economy and the monetary flows in the economy. You see it with the repo market. You see it with customers hunting for returns and pulling money out of bank accounts. You see it with the influx in the money markets, which is actually causing a bigger interest rate liability for the banks that have to pay that out. So people are saying, if I'm going to take this risk on in the system, I want more return. This is what you have to do for me. So as the bad debt accumulates and as interest rates were held low, that created people seeking returns, that created this demand for higher interest rates, which is going to bankrupt the system. Because to replace old debt with new debt, the old bad debt with new debt, you have to refinance at higher rates. That crashes the system, because it is old debt, bad debt, because you can't pay it back. Companies and the government cannot pay back their old debt. There's too much of it. So you're going to have to finance at higher rates. And that risk is in the system, and you're seeing it in the numbers. You're seeing people start to figure out, the market's starting to figure out, this is a fugazi. That's what all that data I just showed you told you. And once the whole world figures it out, that system is going to roll over and it's going to crash. Now, whether all of that occurs in 2023, I don't know. It depends on what programs the government can come up with to try to offset the lack of liquidity in the repo market, to try to inject liquidity into there, to inject a lot of money into there and to buy, other people's debt. Whether the Fed's going to do longer term programs like the BTFP, which is supposed to end in a year, but I think can be rolled over. But it's the central bank basically trying to bail out all the commercial banks, and then the whole thing's going to collapse in on itself. And we're starting to see that get into a later stage, a later maturity stage. And so that we're getting closer to that event in which the banking system is going to lock up, it's going to pucker up, and it's going to start to crash. And then the Fed's going to have to ease at that point. Now, I do think we have some time before that. Inflation is starting to return again. We've seen that in the purchasing manager indexes. It's not fully ramped up just yet. I think we'll have to have at least one more big bout of inflation to force the Fed into either a neutral stance or a tightening stance again. And I think that final tightening is what's going to set that system off. Right now, the system is living at over 5% interest rates on the federal funds rate and the repo rate. And it can do that for a while. But if inflation starts to spike again and the Fed's forced to raise again closer to 6%, all it's going to do is make that problem worse. The debt, people cannot refinance their existing debt. A lot of that existing debt at lower interest rates is going to go bad, and the economy is going to start to crash. And there's not enough dollar liquidity in the system to offset that in the repo market and in the commercial banking sector. So the banks are going to get hit. So it's either going to occur by the second or third quarter this year, or heading into 2024, the whole thing will collapse. I don't think there's much time left in it, in my opinion, based upon the data that I see. So that's today's video. I'm going to go into the specials, the precious metal deals for you guys that are interested. But that basically is part and parcel of the liquidity of the system, what that liquidity looks like, how close we are to a seize up. And again, it had to do with the last 40 plus years of us having an accommodative pure fiat currency system, an accommodative debt policy, interest rates being sat at almost zero or close to zero for the last 10 to 12, 13 years since the Great Recession, increased borrowing, rising inflation, which caused rising interest rates, which caused tightening by the bank, which is causing a seize up right now in the repo market, which has been going on since May. which caused a seize up in the second, third, and fourth largest banks that failed. Not second, third largest, fourth banks, but those were the second, third, and fourth largest failures. And the government came out with the BTFP. They tried to inject liquidity into the repo market. It's not working in terms of being able to offset all the bad debt because the bad debt's still there. The next time inflation spikes, which I think it will, it's going to force the Fed to either stop its neutral stance, stop its loosening. If they were easing, they said they ease maybe 3 to 5 times this year. I've heard different reports. Let's say they ease, but inflation is still kicking up. They're going to have to stop easing and go back to tightening. And it's that last tightening, I think, that's going to break the system, where it just goes into, it'll take a few months, but it'll go into a free fall because the whole system has to collapse. There's not enough low interest money to keep this system going. And there's too much risk that everybody's now hunting for returns in the pension system, in the money market system, in the stock market. And when that stock market crash comes and people realize the stock market's not going to return what it had the last 13 to 14 years, but we're going into a bear cycle, you'll have massive amounts of money pulled out of the corporate sector that will bankrupt the corporates, because if on their balance sheets they have a lot of debt, when the stock prices come down, they'll be lopsided on their quick ratio. The debt valuations will be worth less as assets. Their stock valuations will be worth less as assets. They'll become upside down on their quick ratio, more current and long-term liabilities than current and long-term assets. They'll be functionally insolvent. They're going to go beg the government for a bailout. The Fed will have to take on massive amounts of bailout, and the Treasury and the FDIC will all have to come together and take massive amounts of bad debt on. And that tsunami of bad debt that can't be paid back is going to break the system. How long that takes, I don't know, but we're really close to it. You can start to see it in that data. And typically the inflation cycle is 2 to 3 major spikes of inflation. We're just getting started on our second one, but this time I don't think we need to get to inflation 18% to break the system. I think we are at 18%, but let's take the government CPI number. I think if you get that back to double digits, that's it. That's all she wrote, because it'll force the Fed to go up to double digits, and that would instantaneously bankrupt the entire system. And that's what the Fed's fighting right now. That's why when you see their meeting minutes, they're not sure which way to go. They're using language like, we're not sure which way to go. We need to see how everything happens. Employment looks like it's good, but inflation's still too high. Some of the other sectors of the economy are weak. So the Fed is reading this going, I don't know where to go. And I think inflation ultimately is going to drive the Fed's direction. And when that inflation comes, it's really going to slam the economy, force people to deal with the bad debt situation. And I fully expect that to start to happen in 2023. All right, that's my summary. On to the deals. I have a couple of different deals for you guys. I thought to put up some different stuff on the program. These are very popular. These are U.S. Morgan silver coins. This particular one I'm holding up in my hands, an 1899 O. The O just means it was done at a very specific mint. It's a very pretty coin. These were silver dollars back in the time when silver was money. I believe they're 90% silver. We have these on sale for $29. It's a few bucks off our website, 29 bucks. I'll show you how to go about getting these if you want them. I've got between 30 and 50 in stock, so I'll sell out what I have. These are very popular. A lot of times I'll sell them in 30 to 50 coin lots. So probably the first couple of people that contact me on these will buy these out. These are historic. I have not graded them. A lot of them you can see. This one has really good definition. They're not the super worn ones, so you may end up getting a good or a fine in there, and maybe it's worth more than what you're paying because it has some collectible value. But in any case, I'm not making any guarantees there. I'll sell them at 29 bucks a pop if you want the U.S. Morgans. I also have another collectible. This is a PCGS graded Mint State 70 American Eagle. Mint State 70 basically means it's in perfect condition, never circulated. It's got the grade on here and the certification in the slab. I'm selling these on sale right now for $60. That's $15 off our normal price of $75. And those carry a lot of value because people love these. They give these as Christmas gifts and as gifts, weddings. And then because it's in the slab, you get that additional value of it being a graded coin. Now, it's a modern day numismatic. It's not an historic one like a Morgan. If you like the historic ones, I got those. If you like these, I've got these. The Morgan's 29 bucks. And you may get a pretty good coin. It's worth quite a bit more. And then these are 60 bucks, 15 bucks off. These are collectibles. I have a lot of people buy these. I sell a lot of these, by the way. And then I have a very special collectible. Somebody brought these into my store and I thought it was really cool. We've got eagles that are also graded MS70 by PCGS. So you can see right there. And this one is a 2021, but it's signed. So this one's signed by Dave Robinson. It's a football player, and this is a real limited edition signature on this coin. We have a Wade Boggs. Those of your old school baseball know who Wade Boggs is. One of the best hitters in baseball for many years. I believe he played third base. Paul Molitor, one of the best hitters in baseball. These are all legitimately signed, limited edition. These coins are 150 each. If you're a sports fan or you know a sports fan that likes Paul Molitor, Wade Boggs, or Dave Robinson, we have these coins available. These are the only ones I have. I just have 3. You have to specify which one you want, or if you want all 3. So those are 150. These are $50, just the regular MS70 graded Eagles, modern Eagles. And then if you want old collectible coins, I've got the Morgans, 1921 and before. This one in my hands in 1899, but I got tons of different years. You know, some more common date than others. These are $29. That's a discount of, I think, $3 off the website. It's a pretty good deal. So those 3 products are on sale this week. Now, if you want to get those sales, what you do is you simply go over to our website, www.goldsilverpros.com. That's right, www.goldsilverpros.com. You got to put that www in there. You click on discounts, and you click on access discounts here. And what it does is you fill out this form. I call or email you. We get the invoice out. You pay it, and I have it shipped to you. Or you can pay it and come pick it up in the store if you're in Dallas-Fort Worth. I have people do that all the time. And we've had tons of people, hundreds of people sign up on this list for our deals. We've been doing this for quite some time since we opened the store. This is a good way to get access to that exclusive pricing, which you can't get directly off the website. If you go and buy some of these things on the website, you'll see that they're a little bit more expensive, the regular rate. But if you sign up on this form, because it's a special deal, we'll get you that discount rate. And oh, by the way, on this page, when you click on discounts, in addition to my weekly deals, I also offer deals on other common products, both gold and silver. I have a whole table of products you can get. You can get American Gold Eagle 1 ounces, gold buffaloes, Canadian gold maples, gold philharmonics, South African gold Krugerrands, UK Britannia gold, Valcambi bar gold, Kinesis gold, and 1 gram, 5 gram, 10 gram, and 1 ounce. That's the gold options. These are all for either e-checks, bank wires, or ACHs. I'll be introducing e-checks here pretty soon for those that want to use that. We're going through approval. But if you do it this way, you get these prices listed. Now, this is with spot at the time I put this on. If spot goes up or down, by the time you see this price may change a little bit. We're just charging a small percentage over spot. So you have to basically sign up on this form. I'll call you, give you a current quote based on spot. It'll be extremely competitive to anywhere else you can buy metals. I can promise you that, because it's a little bit of a bulk order. You have to order at least $1,000 of silver or at least 2 ounces of gold. And when you do that, you get these prices and you get free shipping and insurance. All right, we have silver products, the American Silver Eagle, the Silver Maple, the Silver Britannia. We've got a bunch of different bars. I've added different bars. We have the 10-ounce Royal Canadian Mint bar. That's $4.9 pure. We have the Asahi Silver 10-ounce bar. Those are going really cheap. A local mint near me, Dorado, has come out with their own 10-ounce, 1 kilo, and 100-ounce silver bars. They're a refinery. They make them. They pour them and make them. And those are available as well. And those are cheaper. I mean, the Asahi bars are ridiculously cheap. $260 right now for a 10-ounce bar. You can get a Red River Mint 10-ounce bar for $245. That's insanely. That's barely any pennies over spot right now. That's ridiculous. So if you're interested in silver bars, we got great deals. So you can either go with the standard menu of products. I change these prices a couple times a day, but get on the list and we'll quote you directly from whatever spot is when we contact you. Or you can get the products that I shared with you today, which again are regular MS70 Eagles that are going for $50. Those are in slabs. Those are modern day Eagles. You can get the 3 sports figures, Dave Robinson, Wade Boggs, Paul Molitor, for $150. Or you can get the Morgans discounted down to $29. I think that's $3 off the normal. And you may get a fairly good graded coin that's actually worth quite a bit, because I'm basically just selling out my bulk there. If you're interested in those deals, click on that button. All right, that's going to do it for today. Real quick recap. Repo market is drying up. We've talked about it several times, but it's at a crisis point. The reverse repo market's under 1.2 trillion, which the Fed itself has basically said is a danger zone. the interest rates went up. As soon as those interest rates approached 5%, got within 15 basis points of 5%, the repo market started to turn over, which means the short-term liquidity in the system is crashing. On the deposit side, and that's for the big players. On the small player side, the retail side, the people that were invested in the banks took out $1 trillion. A lot of it went to money markets hunting for a return. That created more interest rate liability for the banks, have to pay out those money markets, forcing them to seek higher returns in the market and take more risks. And that's causing the banks to have more cash flow needs at a time when they can get less cash in the system. And as inflation returns again, as it started to, very early, we've seen a slight tick up in inflation. We get into that round 2 of inflation, usually 2 to 3 rounds when you have, right before a recession. We're in that round 2. As that inflation goes up, it's going to force the Fed to either reverse course on its easing that it said it would do this year, or and tighten, or at least keep rates the same. But more than likely, when that inflation rate gets back up to the 9 to 10 range, the Fed is going to realize that them raising interest rates last year didn't work. They're going to have to do it again. And that Fed funds rate may get 8, 9, 10% to quell that. That's what's going to happen during the next round. I think a lot of that action is going to occur in 2024, which is going to cause turbulence all over markets. You're going to see asset price swings in everything from gold and Bitcoin and stocks and land and real estate and automobiles and anything that's an asset. It's going to go like this, bong, gong, 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 and it's going to freak people out. And just remember, you have to do your own research. I'm not your financial advisor. Please contact before you make any decisions. But what I do is I get into gold and silver. Really, gold's best for this long-term portfolio stability in these types of choppy markets like we're probably going to see in 2024, and these types of risk conditions with the cost of money being so expensive and the banks being so close to insolvency. Gold's a great way to store value over time, especially if you're worried about your cash deposits. Obviously, $1 trillion came out last year. People are worried. And silver, as more the speculative metal, if gold goes up, silver tends to chase it and make some money there. It's a little bit more in the speculative end. Certainly, I will be participating in those markets. What you do is up to you. But definitely, I think that you could do worse than being in precious metals, especially with all the problems I've outlined in the program today. All right, that's going to do it for today. You guys have a very blessed weekend. I hope you had a great New Year's and a great Christmas. But we're now into 2024. Time marches on, does not wait for anybody. So now we've got to make decisions on what we have in front of us. Hopefully, this data I presented to you helps. And remember, no matter how much gold or silver you want to buy, I can probably get it to you better than most prices online because I have access to those resources. Just fill out that form, tell me what you're wanting. I'll source it for you and give you a quote. Even if you don't see it on the website, give me a shout. I can probably get access to it. We're full service. We can get as many millions or just a couple hundred. If you just have a couple hundred for precious metals, we can handle that. If you've got needs for millions, we can handle that as well. We can do all of that. Thank you guys so much. It's been Rob Kientz of Gold Silver Pros. Till next time, we'll see you.